Good morning and welcome to this Wednesday, February 16th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Currently, we've got futures turning a little bit lower. We got a really hot retail sales report this morning, and so that's rekindling some inflation fears. Got options expiration this Friday, and of course had a really good session last night. Talked about the possibility that we'll see more action to the upside. We had a good day yesterday. I'm not sure that a lot of it wasn't options driven. We did have a big gap up at the open. Tried to follow up a little bit. We did succeed in that regard just a bit, but for the most part, most of yesterday's strength came at the opening bell. And we'll see whether or not we can continue it as we head into the rest of the week. I do think the overall downward pressure in the market remains. I believe we go lower in time. The question is whether or not we can stave off that 4,300 breakdown on the S&P 500 a bit longer. Let me go ahead and take you over to earningsbeats.com for those of you who are new this morning. First of all, welcome if you are new. We certainly are glad to have you. If you want to learn more about Earnings Beats and what we do and some of our strategies and philosophies and so forth, go over to earningsbeats.com and then just scroll down and you will find an area where you can subscribe to our free newsletter. No credit card required. You can unsubscribe at any time. Simply requires a name and email address, published 3 times a week. Couple of paragraphs and a chart, very easy read. Normally we focus on things like earnings and relative strength and gaps, candlesticks, trend lines, channels, those types of things. But if you are interested in learning more about those different areas and about us, this is a great way to do it because you will get constant information from us. These newsletter articles usually are designed to feature one company, one chart. Could be an industry chart, doesn't have to be an individual stock, could be an ETF, so forth. Some of our subscribers to the newsletter use those for trading opportunities. That's completely up to you. But we do try to provide different things that we really focus on at Earnings Beat. So it's a great way to get to know us if you don't know a whole lot about us. One other thing I'll mention, we do have a free event tonight. And then this weekend, we have our February educational series, the most overlooked growth stocks, I think, when this market bottoms, which I believe it will over the next couple of months. I think we're going to have some tremendous opportunities on some of these growth stocks that are just getting absolutely beaten up. I don't know if you saw Shopify down 50 some dollars earlier this morning. I don't know where it is right now, but Shopify has been a great company and it's been cut in half from its high, maybe even a little bit more than half. And I'm not saying it's at a bottom yet, but at some point it is likely to present itself as a great opportunity. So we'll talk about some of the really nice looking growth stocks that have been just trounced here in the last couple of months, some even going back a year or more. So that'll be this Saturday. You do need to be a member of a member of Earnings Beats for that. So if you click on this and just follow down to the bottom of the page, you will be able to sign up for our service, or you can just click here for no cost trial, either way. But tonight we are having an event. It's free to the public. If you do sign up for our free Earnings Beats Digest, we will be sending out some instructions later on how you can join that event. So it'll be a great event, though, to talk about our upcoming portfolio draft. It's our sneak preview. I'll be honest, our portfolios have not done well, but they're mostly growth stocks, and growth stocks have not done well. We've actually held up much better than other growth portfolios. When you look at the ARK funds, you look at the Innovator 50 IBD fund. I mean, our growth stocks have actually outperformed those. And if you look at the long-term track record, we've outperformed just about every metric, every possible fund and benchmark out there. So we're proud of the work, but this has been a very difficult environment. I do think we're going to bottom soon, fairly soon. And when we do, I think growth stocks are going to absolutely rocket higher. So you at least want to be following these portfolios, even if you're not, interested in investing in growth stocks at this time. I don't blame you based on the way things have gone. Anyhow, let's keep moving. The market recap for Tuesday, the Dow Jones Industrial Average up 423 points, the S&P 500 up 69, NASDAQ up 348. So on a relative basis, or on a relative basis, NASDAQ up 2.5%. That was the big winner yesterday. Mid caps, though, up almost 60 points, a little over 2%. Small caps up 2.25%, up 30 points. So it was across the board. We had some really nice strength. Most of it, though, did come at the open. And then the market, after trying to go a little bit higher throughout the day, did pull back a little later in the day. Technology was the best performing sector, along with discretionary, both of those well up over 2% on Tuesday. And of course, many of those stocks in those two sectors have been beaten up quite a bit over the last month or two, and we've got options expiring this week. So I'm not surprised at all that we've seen some strength in these areas, helping to reduce some of that net in the money put premium that is out there right now as we head toward Friday. Materials up almost 2%. Industrials up 1.5%. In fact, I think it was 10 of the 11 groups were actually higher on Tuesday. The one group that didn't was a group that's been so hot lately. So there's a lot of net in the money call premium on energy stocks, and we actually saw a pullback of more than 1% there. So none of that was very surprising to me. The question is going to be, once we get past this phase of potential manipulation around options expiration, where does the market go? And I think the path of least resistance is going to be to the downside. And maybe we don't even go up the rest this week. I mean, I was talking in the Max Payne webinar last night, and I honestly don't know what to expect in the near term. I really think that trading on either side carries tremendous risk. I think if you get in on the long side thinking that we're going to go higher for the next 3 or 4 days because of Max Payne and because there's so many net in the money puts, the problem is the overall market, in my opinion, is going lower. And so, when does that roll back over and take another hit? It's certainly not impossible for it to do it during option expiration week with all these net in the money puts that are out there. So nothing is impossible. The market is, I think, just going to be absolutely crazy here over the next few days with gap ups, gap downs, intraday moves. Just be ready to be whipsawed, in my opinion. The 10-year Treasury yield. So we got retail sales out this morning. And, I've been talking about the fact that retail sales were so weak the last couple of months. Well, not going to be talking about that anymore. January retail sales jumped 3.8%. I mean, this has just been crazy. The retail sales reports are starting to look like durable goods. Durable goods are so volatile back and forth. Well, retail sales, after being down, 2% last month, actually, they were revised even further lower, down 2.5% for December. January has come roaring back up 3.8%. The estimate was for 2%. So a really hot retail sales report. I'm going to be watching today to see how the retail sales area reacts to this report. But anyhow, retail sales, really big beat there. Later this morning, actually in about 15 minutes, or no, less than that now, about 6 or 7 minutes, January industrial production will be out. The expectation is for a rise of 0.4%. December, we saw a drop of 0.1%. If inflation is really going to continue to pick up, industrial production is going to need to rise. And so we are looking for a little bit of a rise there. Capacity utilization last month was 76.7. And in January, we're expecting that to, or actually last month it was 76.5. This month, January, we're expecting it to jump to 76.7. December business inventories expected to rise 1.8% after a big November rise of 1.3%. So we're seeing inventories build. February housing market index expected to come in at 83. January was 83. So those are the big economic reports that we'll be expecting out, or that we've already seen or expecting out later today. And meanwhile, looking at the 10-year Treasury yield, getting an update here, you can see we are down about 4 basis points, still just slightly above 2%. Haven't really heard a whole lot about this, but we are now with that 2 handle very, very hot inflation report yesterday, and I think it was just absolutely buried in the news. I literally went to CNBC last night. I went through just the headlines of probably the last 50 articles, and not one talked about the fact that the PPI yesterday was 1%, and it was only expected to rise 0.5%. I mean, that's a huge move higher in the PPI, and I could not find an article on it. Not one. No one talking about it. Instead, it was about the Russian troops pulling back from the border of Ukraine and the market going higher. Now, I don't know if that's just a slant, trying to put a positive slant on things because we're in option expiration week and the market's been so beaten up. I couldn't tell you why. I just thought it was really very interesting because we have been reading about article after article after article about inflation, the Fed having to raise multiple times. Yesterday, I just saw none of that. On a day when we had a big inflation report, I don't really get it. But anyhow, just thought it was interesting, wanted to pass it along. All right, moving on to talking technically, wanted to pull up the S&P 500. First of all, if you connect these lows right here, you'll see that there's at least the start of a downtrend. And if you take that same slope and drag it over, it actually connects the highs as well. So we've got this channel now that we have started. And I thought what I would do is just show this. If you haven't seen it, I'm just going to pull it up on a 3-month basis, and we'll do, or let's do 6 months, and we'll do hourly chart. Then I'll add a few extra bars here to this. Okay, so let me show you. And a lot of times what I will do is I will drag. I mean, we now know these lows are in place. I mean, there was a low, big bounce. Here's a low, big bounce. So these were pretty important lows. So what I would do is just kind of drag this down to there. So that's fairly, reasonable downtrend line. And if we grab that and we drag it, look at how nicely that just snuggles right in there to the highs, literally right on the highs. That's a perfect channel. Now, if you're bullish and you believe we are going higher and that this is just temporary, the first thing you want to see is a break above the 50-day moving or 50-hour moving average, get back up above that. Second, you want to break this trend line. And then third, and I think the most important, I mean, trend line is important too, but that's a double top, a key double top. And even you could go over here in January when we came off, or right before we started that January swoon, all the way down on the 24th when we hit that low. That started from about 4,600. We went all the way back up, tested 4,600 twice, haven't been able to get through, and now rolled back over again. Now I think we might be making a Max Payne options related move back to the upside, but the overall trend to me is down. And normally I would probably say, well, we went down, we tested this level, false breakdown, and we're going to move higher. But it's all the other signs that I'm seeing that tell me we're going lower. The sentiment is going to be a big problem, I think, throughout the first half of this year, probably. We need to reset that. The only way you do that is with weakness. Folks are not going to turn bearish if the market keeps breaking out and going higher. So in order to get sentiment to really turn, and I'm talking about sentiment from a equity only put call perspective, in order to get that to turn, we need more weakness. Also the ratios, many of the ratios that I look for sustainability are not supporting this move to the upside for the market. So I just don't think it's happening. It could happen. I could be wrong. Market could be giving me false signals, but I pay attention to these signals because they do help me manage risk. And that's really what I try to use technical analysis for. But if you notice that 4,600 level right there, let me come out of here for a second. And 4,600 on a daily chart. Let's get the daily chart up here. Notice where the 50-day moving average is. It's at 4,603. So you got these tops coming in right here near 4,600, and you got the 50-day. That's a lot of resistance. That's a lot of reasons for folks to sell if we get there. That's still 129 points away, or about 3%. And then we've got also maybe about 4% down to this 4,300 level. So we're really in the middle of a very wide 300-point range on the S&P 500. And by Friday, I could see us at 4,600. I could see us at 4,300. I could see a breakdown. I don't believe we're going to break out just because of things I just talked about, but I could see a breakdown all within now and Friday. I mean, it could be anywhere. So that's why I just think, cash is definitely a good place to be. What I would be really careful about is chasing. Seeing yesterday a big move up, and then you're watching today, maybe we get another rally later today and we get up to 45, 40, 45, 50. And you're like, oh man, it's going up without me. Let me jump in. And then maybe you get another 30, 40 points out of it, maybe. And then right back down we go. So I think this is going to be a really difficult time to try to trade the market, just because of the volatility being high and the ranges being wide, and believing this is a cyclical bear market. If it's a cyclical bear market, when it starts to go down, it takes no prisoners. It doesn't stop, and let you out. The drops are just, mind numbing. Sometimes you just sit there and you're just staring at the prices just continue to go down. Market makers go on what I call vacation. So they're not providing liquidity. In fact, if anything, they're on the short side, making more money. So you just get this significant amount of supply and almost no demand, and prices just go straight down. I mean, here was a perfect example. We were within 1 or 1.5% of the all-time high when that January swoon kicked in. Now we're getting our little temporary reprieve, but I think we could get another one of these moves, something similar. And maybe it starts after we hit 4,600. Maybe it starts right from where we are now. Maybe it waits. Maybe I get the head fake. Maybe we go up through 4,600. And then maybe there's another move down. And of course, there's always a possibility I'm just completely wrong and it just keeps going up and we get a new high, all-time high. But if it does that, we're going to be looking for some signals to support it. We don't want to be doing it with just energy and materials and consumer staples and financials and healthcare. And we want to see technology. We want to see some of these growth areas begin to pick up on a move like that. So that's what I'd be looking for if we continue there. With the NASDAQ 100, the NDX, of course, this is even more heavily concentrated in stocks like Apple and Microsoft and Google and Amazon and Tesla and so forth. This one has a much more downsloping neckline and a downsloping right shoulder. This index actually looks worse to me than the S&P 500. And we've got the same kind of a channel. Let me pull this up on an hourly chart and we'll go back 4 months. And let's pull this up and see what it looks like here. So let's grab that trend line again. And if we go from here, let's grab that right about there are the lows. I mean, once again, almost perfect connecting the highs, pretty close. So you've got 14.8 resistance coming up. That's 180 points away. So, I mean, we're talking about what, 1.3% till we hit trend line. And then if you really wanted to look up above at some of these key areas of price resistance, I think the big one's right there. Here you can see an obvious low. And then you can see the bounce. You can see the big breakdown, heavy volume breakdown that took us down to January 24th. Went all the way back up, tested that breakdown. And then we've now been drifting down again. I mean, the overall chart here to me really does not look very good. And so we've got work to do on the bullish side. It's hard to be bullish with the signals that I'm seeing, plus with these channels. We got to make a break back to the upside to even begin to reconsider the short to intermediate term. All right, let's take a look at the relative strength. Haven't done this in a while. Let's look at the sectors. This is a long term. This is 15-year relative strength chart. I'm really just focused on what's going on here since the end of 2021. And you can see the technology group on a relative basis has been coming down. Now the overall has been very strong. I don't know exactly how far down we go here, but I do think because we have rallied so much since the beginning of 2019, I wouldn't be surprised if maybe we were to pull back and even test this prior low over here. And if we do that, that would likely coincide with some pretty bad action in the market. Normally, market doesn't go up if the XLK is underperforming, because the XLK is about 28% of the S&P 500. So if 28% of the S&P 500 is underperforming, it makes it really hard on the other 72% to go up enough, to outweigh that. Next up, consumer discretionary. You can see some recent bottoms right here, and that was an area where we broke out from back in 2020 after the pandemic. So we've gone back and we've tested that level. We're starting to see a little relative strength here. I mean, I'd like maybe for consumer discretionary to kind of go sideways and not break down again. We do have a trend line here that would be worth watching, maybe connecting these lows. Maybe we do have a little bit downside. I definitely would not want to take out this low. 0.037. That would really be a bearish signal for the market. Communication services has already fallen apart. I mean, this group fell apart back in, I don't know, maybe September from this high, and it's been going straight down. The internet stocks really been struggling. Facebook has been horrible. Google, Alphabet, even after breaking out with earnings, straight back down after that. I mean, there's just been no sustainable rally in the major internet stocks, and that's been having a lot of problem on the communication services. Also, you've got the entertainment group, broadcasting entertainment. You got Disney, companies like that in this area that make it difficult as well. Industrials on a relative basis, even with interest rates going up. This is normally, and this is a sign to me that the market's more worried about that interest rates are going up more because of inflation than because of our strong economy. Because if interest rates were going up because of the strong economy, we should see industrials moving up on a relative basis throughout that climb. Transports, if the economy is strengthening, transport should be doing well, and transports are a big part of the XLI. So the fact that we just keep coming down tells me that the market, at least the stock market, is more concerned right now with inflation. Financials have actually broken out to about a 2-year relative high. So the move up in the yields and that yield spread have helped financials, especially areas like banks, life insurance companies, outperform on a relative basis. So this has been one group that is actually doing pretty well. Doesn't mean that the group is necessarily going higher. Here, look at, well, I don't know why technology is on there. I think I forgot to change these things. But if we pull up, make sure that's financials there. But if you pull up the financials here, you can see that we did pull back recently. I mean, we're breaking out to new relative high, but that doesn't mean that you're going up in the group. It just means that you're not doing as badly as the S&P 500. So you can go down 5% while the S&P goes down 10%, and your relative strength will go higher. So don't always think relative strength means absolute strength. It doesn't always mean that. Healthcare, I've been pointing out for a while now. I'm watching. This is a major multi-year relative support level. So it looks like healthcare trying to roll back over again, but we've got major support not too far away that we want to keep an eye on. Consumer staples, since we've seen the market really weaken November, December through now, you can see that relative strength picking up. That's what I would expect. Again, let me go down here and change this to XLP. So on an absolute basis, you can see us starting to roll back over, but we've actually done pretty well, even on an absolute basis for the last, year as the market's been really volatile. Consumer staples was going up, but it just wasn't going up as fast as the market. You can see that in the relative weakness. But now, over the last few months, it's actually setting new highs and it's leading on a relative basis. So this has been an area, this is where most investors and Wall Street will turn when they're not comfortable with those aggressive sectors. Risk off means more money flowing toward consumer staples. Real estate, same kind of a deal, even though real estate's been weak here to open 2022. Normally, we're going to see strength in real estate when the market is weak. It's more of a defensive group. Also, I would expect it to do well during an inflationary period. It did well in 2021 when we had the huge spike in the inflation. Back February to May, you can see a huge rally. So I'm not quite sure what gives here and why it's struggling so much with inflation picking up. I would expect that the relative strength would be really good, and it has not been. Utilities, again, a defensive area, so I would expect strength when the market weakens. We saw that, but even utilities coming back down. One thing that hurts utilities is when the Treasury yields rise, the utility dividends are not quite as attractive to income investors. If an income investor can go with something like a Treasury, you're not going to make as much money as you would with dividends on the utilities, but you also don't have nearly the fluctuation. So I don't know. I think 10-year Treasury yield for some income investors is going to be more appealing. And as a result, we get the big breakout. Sometimes that's going to have a negative impact on utilities. I expect utilities to kind of just go along for the ride with the S&P 500, maybe outperform a little bit. Energy, clearly the leader right now. However, it has made this run from where it started its absolute tumble. I mean, it's been downtrending versus the S&P for many, many years, since it peaked in 2008, and especially since it peaked in 2011. But that weakness really accelerated through the pandemic. If you remember, you could actually store crude oil in your swimming pool and they'd pay you to take it. I mean, it was negative. There was a negative cost to crude oil. They would actually pay you to take crude oil and store it. That's how bad things got. So now we've seen crude oil move all the way back up near $100 a barrel. And so obviously we've had this huge rally. I've said it before and I'll continue to say it. I don't think this continues. I think once the inflation scare is behind us and the market starts moving up and growth stocks start moving up, I think energy is going to get hit, and probably get hit hard to the downside. So I think this overall long-term downtrend is still intact. I think we just went out of this channel and now we've come back and gotten into it. If you connect these highs, we're getting pretty close to where we'll probably see a relative peak in energy. Materials on a relative basis, just kind of going along for the ride here over the last 6 months or so. But like energy, the overall downtrend remains intact, the relative downtrend. All right, earnings spotlight. What I wanted to do, we had someone write in and say, I don't know how to download the charts into stock charts. Most of these webinars that we do, we're talking about chart lists that we've created. Now you can download the chart list into your account. Well, if you're a member at Earnings Beats and you're also a member at Stock Charts, Extra or Pro, if you're a basic member, you can only have one chart list. So you're going to get your default. You're not going to be able to download anything from us because you already have all the chart lists that you can have. But if you're an Extra or Pro member, you can have, I think, 250 or 350 chart lists, depending on which one. Might even be more than that now. I'm not sure. But anyway, if you go in for earnings, what I wanted to do is just show you, I have set up a chart list in this particular stock charts account. I have this upcoming earnings, 2:15 after the market closes to 2:16 before the market opens. So every company that reported after the close yesterday and before the open today will get their first earnings reaction here in about 2 minutes. So what I wanted to do is show you, and anybody, by the way, on our EB Digest, if you're a free EB Digest subscriber, we put the links in so that you can download these earnings chart list into your stock charts account if you're a stock charts member. Anyway, I just wanted to show you, I've already set up a chart list, which is empty right now, has nothing in it. And I'm going to show you how easy it is to download right into that. So I'm going to download into this account 01093 upcoming earnings. All I do is I go grab the chart list down here at the bottom. This is Tuesday after the close, Wednesday before the open. I'm going to copy the password. I'm going to click on the link. I'm going to paste the password, and I'm going to unlock the list. Now, if you're not a member at Stock Charts, you're not going to see this save to chart list. Instead, you're probably going to see some ads, and you'll be able to see the charts, but you have to flip through them one at a time. If you're a Stock Charts member, Extra or Pro, you'll see this button to save the chart list. And now I'm going to replace the list I just talked about. Remember, I set up this upcoming earnings 01093 for this day. I'm now going to save the results. There's one chart in there. It won't load. Shoot. We have this problem every once in a while. Let me see which one it is. Let's go in here. Usually I take care of this before we send it out to members. Obviously this one. See, now I have 2 of these chart lists. It tried to save it into a different one. So let me see where it went. Probably site is the one. Let me delete this chart and then we'll, oh, I can't delete it from here. I got to go over to my other account. Bear with me 1 second because I do want to show you how cool this chart list is. All right, so it's 215 to 216, and it was site. I'm going to delete this chart. Okay, now I'm going to go back and I'm going to try it again. So copy. Oh, didn't have, I've already downloaded it once, so I didn't need to use the password again. All right, so now let me try to save this chart list again, see if this works. Okay, boom. For whatever reason, there's something that Stock Charts doesn't like. I had to take out the last chart in that particular chart list when I downloaded it the first time. For some reason, Stock Charts doesn't like that chart. And I get that every once in a while when I'm doing the strong earnings chart list or the strong future earnings chart list or raised guidance. I mean, sometimes for whatever reason, Stock Charts just, there's something bad, and I just need to get rid of that one chart. Anyway, so now it's downloaded. So this is now in my, my own account. So if you did that, you'd now have it in your account. And then the cool thing is now the market must have just opened. Yeah, 9:32. So the cool thing is now we have all of the companies that reported earnings last night or this morning in one chart list. So you can see the initial market reaction. Sometimes what I'll do is I'll leave this. So I checked it at 9:32, and this is what it was. And then I'll come over and I'll look to, I'll pull up the same chart list, view all, summary. And so now I'll have it back to back. So now I've got it at 9:32 here, and I've got it at 9:33 here. And what I can do is I can start seeing the changes at the top. So Upstart was up, when I first pulled it up, 23.74% to 23.74%. And then second time I pulled it up, it was 22.58%. So just gives me a sense, okay, we gapped up, we're starting to move lower. When you get a gap up, a lot of times market makers, well, not a lot of times, everybody wants to buy. Market makers are on the short side. And sometimes you see these stocks take an initial move to the downside. We've seen it recently with stocks like Enphase and some other companies that gapped up. I mean, Google gapped up and then sold off. To a lesser degree, I think Amazon, it gapped up, kept going up a little bit, and then it pulled back. But we see it with a lot of companies. And then we can pull up the chart and take a look. So Upstart, initially it got up to 141. Now it's at 134. So it's down $7 off the high, or $6 and change. Anyway, let's take a look. Last thing I had is the 3 you must see. I'm going to just go through these pretty quickly. And these were 3 big movers yesterday. The first one was MedPace. Pull it up on a relative chart. But I mean, you can see the huge move to the downside, massive volume. This is definitely a broken chart. Yeah, we might get a dead cat bounce. Might even put a Fibonacci on there and maybe look at some of the retracement areas where we might see a move back up. But I don't think the selling's done with a stock like MedPace, not after that kind of a candle. I'd be really surprised if it just went right back up. Next up, Sabre Corp, SABR. This one actually had been downtrending and had really good volume, probably about 3rd or 4th biggest volume of the year. And looks like it broke the downtrend. So this is one that potentially I'd keep on a watch list if it continues to strengthen, maybe on a pullback to that 20-day moving average. This is one that looks pretty good. And then finally, Constellation Brands, STZ, another big drop to the downside, seeing that dead cat bounce, but I really doubt that it's going to last after a big drop like that. We cleared that short-term uptrend line, and so I would be looking for this now to become much more of a downtrend from here on STZ. All right, let's get a quick look at the market, see what's going on. We're 5 minutes in. I apologize being a little bit late here. NASDAQ down 119. So we are now seeing a little bit more weakness on those NASDAQ shares. We'll see whether or not we get a bounce back because of options expiration. But as I said last night, and as I said at the opening this morning, I honestly don't know which way this thing's going to go in the near term. I could argue near term options expiration, we're going to rise, but I believe the market goes lower. And it could be a very impulsive move very quickly. So if you are in on the long side, just make sure you keep your stops in play. And expect the unexpected. I mean, we could have some whipsaw. You might get stopped out and the market comes right back. I mean, that's what happens when you get the VIX up in the 20s and 30s. VIX right now sitting at 26. That's very high. When we get into a really strong bull market, you're going to see that VIX down at 10, not at 26. Not at 30, not at 39, where it was when we bottomed on January 24th. So we got work to do. We got volatility to get through, and we'll see whether or not, the market can sustain this short-term advance. Right now, obviously having a little problems. All right, that's it for me. Appreciate everybody tuning in. Be back tomorrow over at Stock Charts TV at 9 o'clock. For your next Trading Places Live. It'll go from 9 to 9:30, and it'll be a recorded version. So all you have to do is go over here, click on this at about 9 o'clock, and just start the, following their TV feed, and you'll have the show. Listen, have a great day, everybody. Be back later with my daily market report. Happy trading.